Have you ever wondered why India's economy is growing, the stock market is booming, and yet private companies are just not investing? Very few new factories, no bold expansion plans, and low risk taking. It is like everyone is holding their breath. Well, what if I told you this has less to do with money and more to do with the mindset? Hi, I'm Pranshumaan and I. I'm a former investment banker with over a decade of experience in corporate finance and mergers and acquisitions, and now I help people like you understand markets, personal finance, and how to build a career in the finance industry. If you are new here, do consider subscribing. We break down complex financial topics in a way that is practical, jargon free, and focused on what really matters. Also, if you're thinking about becoming a SEBI-registered investment advisor, check out our NISM 10th A course. It is live now and designed for anyone who wants to break into this high potential field, even if you're new to finance. We've got live doubt sessions, a community group, and practical guidance on launching your own advisory business. All the links are in the description. Now, back to the story. Today, we are diving into why Indian companies are holding back on capital expenditure or Capex and how it connects to a fascinating economic idea called a balance sheet recession. Let us unpack this. In 2019, Finance Minister Nirmala Sitharaman took a bold step. She slashed corporate tax rates, sacrificing 1,45,000 crore in revenue to encourage companies to invest and expand. Now, 6 years later, the private sector has not quite delivered. Despite India's GDP growing and the government pouring money into infrastructure, corporate investment or Capex has remained subdued. Government surveys suggest that private Capex intentions are also falling. So what is going on here? Now, you would think that this caution would be reflected in the stock market, but it is not. The Nifty 50 has been flying. Companies like Trent and Adani Group are posting strong returns and investors are cheering. And here's the irony. These rising stock prices are actually one of the reasons that companies are not investing. See, most companies are laser focused on a metric called return on capital employed or ROCE. Think of ROCE as a report card that shows how efficiently a company is using its money. The higher the ROCE, the better the company looks to the shareholder. But here's the catch. When a company decides to expand, like building a new plant, opening new stores, it has to spend big, and that dents ROC in the short term. And lower ROC usually leads to, you guessed it, lower stock prices. So companies are choosing to protect their image and their market cap rather than risk short-term ROCE dips, even if it means sacrificing long-term growth. So this brings us to the idea of a balance sheet recession. Coined by economist Richard Hu, the term describes a situation where companies stop borrowing or investing not because interest rates are high, but because they are focused on cleaning up their finances. After a major shock like a financial crisis, firms enter survival mode. They pay off debt, hold cash, and avoid risk. Japan in the 1990s, the US after the 2008 crisis are both classic cases. Companies simply did not want to borrow, even if the government offered cheap money. Now, India has not gone through a giant financial meltdown, but the mindset is creeping in. After demonetization, GST disruption, COVID, and now global uncertainty, Indian corporates have become more cautious. They have deleveraged, improved their margins, and built stronger balance sheets. But they are still reluctant to take risks, especially when consumer demand feels unpredictable. It is not a full-blown balance sheet recession yet, but it is definitely a capex hesitation syndrome, rooted in the same psychology. Not every company is on a pause though. In FY25, Nifty 50 companies increased their net fixed assets by 12%, up from just 7.5% in the previous quarter. Companies like Trent, whose stock is over 900% up over the 5 years, have ramped up capex aggressively. Their gross block, which is the fixed asset base of company, grew by 80% last year, showing confidence in future demand. We are seeing a similar trend in healthcare, cement, and chemicals as well. These are sectors where demand visibility is better and where high stock prices allow companies to raise capital easily. This follows a classical pattern known as the capital cycle. Stock prices rise, capital becomes easier to raise, then the companies invest and new capacity builds. Eventually, overcapacity brings prices and returns down again. But the Indian companies today are cautious not to overbuild. They have learned from past cycles. So let's talk about what all this means at a macro level. Number one, employment can slow down. New investment creates jobs in factories, services, and infrastructure. If companies don't expand, job creation will suffer. Second, we risk supply shortages. If consumption picks up and capacity has not been added, we could see price spikes or become more reliant on imports. Third, India misses productivity gains. Without capex in automation, logistics, or manufacturing, we may fall behind global peers in efficiency. And finally, stock market can disconnect. If stock prices rise without real economic backing, we risk building bubbles that could eventually burst. Now, there are also signs of optimism. In FY25, surveys showed that there was some uptick in private sector investment intentions. But for FY26, the mood seems to be cooling again, largely due to global instability and uncertainty around domestic demand. To shift this narrative, companies need more than tax cuts or cheap loans. They need confidence in consumer demand, in policy stability, and in long term visibility. Newer age businesses and startups seem more willing to take risks. If they scale, then they might lead the next investment wave. But as of now, large listed corporates are still in capital preservation mode. So here's the big picture. Indian companies are in good financial shape. They have cleaned up their balance sheets, but many are still scared by the past volatility and are playing it safe. That is not all bad, but it is not enough either. For India to truly become a 5 trillion or $10 trillion economy, we need bold, smart long-term investments, not just strong stock charts. If you enjoyed this breakdown, please hit the like button and subscribe for more videos on markets, careers, and financial strategy. And if you're serious about making a career in finance or advisory, check out our NISM 10th A course. It is open now and tailored for people who want to learn and start earning. The Telegram link is in the description. So join us and let's build together. See you in the next one.